Okay, so we're going to finish up Chapter 8 today. We're going to go over dollar value LIFO. So did y'all work the dollar value LIFO problem on the homework? And how did it go? Not? Jillian? Not? Not good. So, yeah, I was looking at that last night and I was thinking, oh, wow, I bet this isn't going to go so well. And so last night I started to open it, say, okay, I'll give y'all one more day. But then I thought, well, what's going to happen is you're just going to say, okay, I'll wait another day. And so kind of that was kind of bad because what I did was torture you in a way. And now, I don't know. We'll see. I mean, you think it went really bad? Did you get an answer? Jonathan, you're not saying a word.
I got an answer.
You don't know how bad it went, right?
Yeah.
Okay. All right. That's fair enough. Yeah. So we'll go over it today after you've been tortured. I guess I'm kind of good about the fact that at least now you know how hard this could be, the dollar value LIFO part of it. And so now maybe the part in class will, people hate it when I do this though, I know that, but the part in class, well maybe it'll sink in after you've already seen it once and then you see it in class. And then if I need to, maybe we'll kind of almost take a vote after class to see if I should open it up back again. Where like I get a lot of votes and y'all get very few votes kind of thing. Okay, but now you can give me some input as far as do we need to open it back up again? Okay, so talking about LIFO. So remember we talked before about 4 different inventory methods, and LIFO was one of those inventory methods. And a lot of people choose LIFO for their inventory method because of what reason? Choose LIFO because low income and as a result low income taxes. Okay, so that's a very popular method. But you know how we talked about the spinach beforehand, remember that example where now you're left with in your inventory the very, in effect, the very old spinach. That the things that are in inventory are the old things, right? And the things that are going to cost of goods sold are the most recent things. Okay, so the problem with LIFO is, all right, so these are the pluses and minuses of LIFO right here. But sometimes LIFO can cause some problems. And this is one thing that we haven't really talked about. When we come up with our inventory value, we're probably going to have to adjust our records then. What we'll have to do is adjust our inventory records to match the inventory method that we've come up with, and we're going to have to reduce, in this case, reduce inventory to LIFO. So we'll have to make a journal entry. And the journal entry will look like this. We're going to have an allowance to reduce our inventory to the LIFO method, okay? So this is called like a LIFO effect. Reducing our inventory, increasing cost of goods sold. So each year, we're going to have to make an entry like this to adjust our books to LIFO, okay? But it could be that some years, so we'll have kind of what's called a LIFO reserve, okay? So the company has to disclose the amount of their LIFO reserve. Now, why is this? So that investors can tell what is the company's effect of assuming the LIFO method. The investors can tell that the company has like this positive benefit just from the LIFO method, okay? Okay. But now we're coming to one of the problems with LIFO, and that's LIFO liquidations. Okay? So companies will have been building up a reserve, a positive benefit that's caused them to have lower taxes. But what would happen if the value of their inventory significantly decreased? Okay, like for instance, they sold all the spinach in the store. Okay, so see, like, I don't know why we're using the spinach example, but sometimes like my spinach goes really bad. Do y'all even eat spinach in bags? Yeah. This was something that, people never ate before, but now all of a sudden I eat a lot of salads. Okay, it could be anything, but spinach came to my mind. So like the way that LIFO works, let's say this is our year 2010. Let's make it 2008, okay? So, and let's say in the year 2008, here is our spinach. This is how much spinach we had, okay? Or this is the, amount of our spinach inventory. And then let's say in 2009, we added more spinach on top of that. Our inventory is growing, right? So I don't even know how much spinach costs, but let's say our little bag of spinach costs $2. So here it costs $2, and here our little bag cost $2.05. And then we added some in 2010, and this time it cost $2.10. Do you see how our prices are increasing, and we're increasing the amount of inventory that we have, spinach inventory? But let's say, and it keeps on going like this, and eventually we get to $2.25 or something as we go on. But let's say in the year 2013, for some reason, people have started eating a bunch of spinach, or at the end of the year for some reason, our spinach inventory goes way down. So in 2013, we only have this much spinach, right? So now we've since we only have this much, we have used up all these layers of spinach from previous years. So from prices of $2.25, $2.10, and $2.05, and now all of our spinach from 2013 is going to have to go back to this $2 price. Do you see what I mean? We're eating into our layers, and we're losing our LIFO effect. And now this is going to be a negative thing for the company, okay? Maybe it's not so obvious why this is going to be a negative thing, but as long as you're building up layers every year, then you get a positive benefit from LIFO. But when you start eating into the layers, then you have a negative benefit. And that's what that's called as a LIFO liquidation, when you're liquidating the layers. Did y'all notice in the problem that y'all had for homework that there might have been 1 year that the layers decreased? Yeah? What's that?
I think it was the last year.
Yeah. So the layer decreased, right? What did you do then? Throw your hands up? Yeah, so that's the problem. What do you do then? So like you see what I'm saying here, we have to go back. If we eat up this layer, then it's gone. And then this layer would be gone. And then, depending on how far down we go, we're eating up those layers, and those prices right there are no longer relevant, okay? All right, so we'll come back to that. So the LIFO liquidation problem, when we sell that old inventory, then we have lower cost of goods sold, because see, we're eating up these lower prices. So our cost of goods sold instead of $2.25 would be some of it at $2.05. Well, I guess that doesn't sound such a big deal for bags of spinach. But it could be a real problem for the company if they start eating into their layers. And in reality, you don't really use LIFO for things as small grained as bags of spinach, but it would be like you would use LIFO for, let's say, cold products or, canned goods or, big in a grocery store, you might have 3 separate sections: meats, let's say, cold things, or the aisles or something like that. You might divide up your inventory into 3 pieces. Okay, but if all of a sudden one of those went down, then you would have what's called a LIFO liquidation. So most frequently, you might pool your inventory into small groups like that. Okay, so this is, so here they're trying to give you the distinction between the specific goods approach, which would be you're keeping track of your spinach, and what would be, a problem with the specific goods approach, like in here, where the costs are going up, the cost of your ending inventory are going up, but if you sell some of it down, if you sold some of that, see in this case on the right, we've sold everything down to the 6,000 pounds remaining, that little dotted line on the right. Okay, so we've sold, and we no longer have those layers of inventory from 2012 to 2014. All of that's gone. So that'll give you higher income and a higher tax bill, the fact that you've done that. Okay, so as a result of these problems with LIFO, the liquidation problem primarily, dollar value LIFO was created. Okay, so now, you remember just how I kind of hate the whole idea of LIFO. Dollar value LIFO is even a little bit more ways to manipulate income to me. I mean, it's very manipulative. But this is the, generally accepted way of doing stuff, dollar value LIFO. So here we put things in pools, and a few pools, and that helps protect, each thing like spinach, meat, every little thing having to maintain this higher level. Because imagine the problem that managers would face if they felt like their inventory was going to get eroded. They might just go buy a bunch of stuff just for the fact of keeping their inventory levels up. And so that just promotes bad behavior. So dollar value LIFO kind of helps to solve the problem. Okay, so this is the example that we're going to use, which is, what I passed out here, right here. So I wrote that stuff on the top. This to me looks like a valid problem for dollar value LIFO, okay? Like this, a really good example. And the way that it would be presented would be, here are your ending inventory values for these years. So see, they're giving you the ending inventory at end of year prices and the price index. So what do we mean by that? Ending inventory at end of year prices. So let's just go with the grocery store example, for instance. Ending inventory at end of year prices, what does that mean? They went and they took an inventory of the stuff that was on their shelves, counted everything at the current price, the price at the end of 2014. And when they did it in 2013, that was the price. And then when they did it in 2012, that was the current value of their inventory. Okay, when they counted it in dollars. And then what does the price index mean? So for instance, the price index in 2012 was 100. Why is that? It's because the first year that we have inventory, we're going to count that as like the beginning of time. for our inventory. So whatever the prices were at that time, we're going to count that as the normal, our mark, our starting mark, okay? We're going to draw a line right there and say that's our starting mark. So now prices increase, around here every year. And then we have what's called a consumer price index, right? Y'all have heard of the consumer price index. So it might go up every year. They'll let you know, prices went up 3% or 2% or whatever it was. When the price in year 2, which was 2013, the price is 105. What does that mean? How much did prices go up from year 1 to year 2? 5%. Okay? So the prices went up 5% that year. And then in 2014, prices went up to 120. What does that mean? 20% over the first year, right? So since the first year, prices have gone up 20%. But in that 2014 year, our inventory value was $108,000. But it's $108,000 in current year prices, right? So the whole situation with dollar value LIFO is we are trying to compare apples to apples, okay? And so we have this long process that we go through to compare the apples to apples, right? So we've got what I've given you there. Well, I've kind of given you the answer, haven't I? Right? On this sheet? But which we can go through step by step, right, to see how we came up with it. Okay, so, and I've put, divided by, multiply, that sort of thing up across the top. And so what we're going to do is go through, how this was all calculated, okay? So in year 2012, we counted our inventory, and we call, that's the base year. 2012 is the base year because that's our first year. And we counted the inventory, and it was $80,000. And we said that our price index on that year was 1. So our end-of-year price inventory is $80,000. And our dollar value LIFO price, see on the far right, is $80,000. And how did we get that? Okay, we took our 80,000, we divided it by 1, we got 80,000, then we multiplied it by 1 and got 80,000, and so that's our layer, 80,000. So in the first year, that's going to be our base layer. So our 2012 layer is 80,000, right? Okay, so we're all clear on the first year, right? That's kind of a piece of cake. Now we go to the second year. Now in the second year, when we went and counted the inventory, we got 111,300 worth of items in current year prices, end of year prices, okay? Now what do? We divide that by 1.05. And when we divided it by 1.05, we got 106,000. So now we can say, how much did we add to our already $80,000 layer, right? So we can divide that 106,000 into 2 pieces of base year price numbers, okay? The 80,000 plus another layer of 26,000. See, that's at our base year prices. Do you know what I mean? At back in 2012 prices. So now we can compare apples to apples. They're both at 2012 prices, and we know that we have an 80,000 layer and a 26,000 layer. Okay. So in other words, we're building another layer here in 2013, and at base year prices, this layer is worth $26,000. Now, we're doing the 2013 financial statements at this point. We don't really want 2012 numbers. We just divided it up so that we could see how much was really in that layer. So if we multiply this times, 1, we get 80,000. This is going to be our ending inventory prices, see? And then we multiply this one times 1.05, and we get 27.3. Then this is the value of our inventory at the end of 2013. So at the end of 2013, our inventory value would be 107.3. You see how this 107.3 is less than the end of year price that we started out with, the 111,000, and it's less by $4,000. And that's the amount of our LIFO reserve. That's the amount that we would make a journal entry for. How are we doing so far? Okay. Jeremy, how are we doing so far? This is okay now? Okay. You think it might have been wrong on the homework? Okay. All right. All right. So now we're going to go another year, right? In 2014, we counted our inventory and we only had 108,000 in inventory. Prices have shot up, apparently, and now our index is 1.2. And what we want to do is to divide that 108,000 into our base year layers. And how do we do that? We take the 108,000 at this year's prices, divide it by the current price index of 1.2, and we get 90,000. Okay, we had a layer, we had these two layers here, right? We had these two layers. We had an $80,000 layer from 2012. Now we only have 90,000 of base year prices. So our next layer is really only 10,000 at base year prices, right? So since we only have a $10,000 layer, what do we value this layer at? Where did this layer come from, in other words? What year? So that's the question, right? So what year did it come from? The deal is we had this right here. Now we only have a $10,000 layer. What we are doing is eating into this layer.
Is that why you use the 1.05?
Right, right. That's why you use the 1.05. So with this layer right here, we ate into part of our 2013 layer. And so we use the 1.05 from 2013. We did not add any more layers this year in 2014. We didn't build up our layers. We shrunk our layers. We ate into our layers. We had a LIFO liquidation, right? So that's what a LIFO liquidation is, when somehow we eat into our layers, which is what we did. So now we have, in 2014, we have two layers, 80,000 and 10,000. And we multiply them times our price index, which was 1 right here and 1.05 right here, to get our dollar value LIFO inventory. So we get the 80,000 and the 10,500, and our ending dollar value LIFO is 90,500. So our inventory that we counted and said it was today worth 108,000, for dollar value LIFO purposes, we're only going to put it on the books at 90,500, which means we have an adjustment to make to bring our inventory down by 17,500. Okay, so any questions about this one? How much is the LIFO reserve?
Like,
How do you get it? Not, the 108,000 minus 90,500. The first column over there, 108,000, minus the 90,500 in your LIFO column.
oh, okay.
And this is all just to kind of smooth out your LIFO inventory so that you don't have to pay as much tax.
Right. It's instead of using specific goods method, you count your entire, basically section of the store, and get these end of year prices and use these things to manipulate it into a dollar value example. Yeah. And the two purposes of it, number one is to use LIFO to lower your taxes. Number two is to use dollar value LIFO so that you have a big pool of goods and you're not worried so much about the spinach and the spaghetti and that kind of stuff. You're worried about the big pool. And it's easier where each one, you're not worried about each one going up and down, but your inventory kind of more as a total. Yeah, where did we get the 1.05? Is that what you're wondering? Because in 2000, let's just have another problem. In 2014, if we counted this and we had 200,000 worth of inventory, let's say, clearly it went up, then we would have had another layer in 2014 and it would have however much it was, and we would multiply it times 1.2, right? If it had gone up in 2014. Our inventory did not go up in 2014, so therefore we don't have that layer, and as a matter of fact, we ate into this layer. Yeah, so since we still have a tiny bit left of this layer, we use the 1.05. If, we could have eaten into all the way down to this and just had the 1, the base layer.
So, let's say you had 2015 year, you would basically get into the 2000.
All right, let's say in 2015. Now if we had 2015, we start the year with just these two layers. And whatever happens from there, we either add to these two layers or eat into them. We just forget about if in 2015, it's like that 1.02 doesn't matter at all because that's not a layer. We only have these two layers. We only have 2012 and 2013 at the beginning of 2015 if we were to have another year. Are y'all following what I'm saying? Jillian's not. Okay, in 2015, we're starting at this point, just these two layers.
So in like 2050,
Yeah.
we kept going and we ate into it. We would have an inventory at 2012 and then 2050.
Yes.
Potentially.
Yeah. Yeah. You could just have that super old layer and then now this layer from this year. The purpose of this, yeah, you're still trying to get, why is somebody torturing me like this? It's to keep your taxes low.
How long does it work for? It works forever.
It works for as long as you keep this base year layer, or as long as you keep these old layers. When you start eating into the layers, then it's a problem. So what we're doing is we're matching our cost of goods sold with current prices, current higher prices, rather than old prices. LIFO, last in, first out. The last cost in goes to cost of goods sold rather than going to inventory like it would in FIFO. Yeah. Okay. So this here's an example, right? We're going to have a couple more examples of LIFO. Okay. So, well, yeah, we're something to look forward to, right? We're going to do brief exercise 9. Well, I tell you what, why don't we get through with the slides and then we can just be done with that, okay? We'll go back and do those later. How do we get a consumer price index? Where do we get the consumer price index? For like a grocery store or a Target or something like that, they might use the real consumer price index. There's a lot of consumer price indexes for cars, clothing, whatever. But so there's one for urban consumers, and so you could take that government-approved consumer price index and create the index, okay? Or it could be based on your particular goods and how much they've gone up. You could create your own price index. But if you're going to use the government one, or whichever one, you're going to take this is how you can create an index. Ending inventory at current cost divided by, that same kind of inventory at whatever it was the base year to get an index for how much it's gone up since the base year. Okay, so like how much was spinach back in 2012 compared to how much spinach is this year, And so that's how we get the index. It's just a matter of how much things have gone up. You're just getting a percentage there. Okay? All right. So I think we've talked about that there's specific goods LIFO, specific goods pooled LIFO, where you pool a bunch of stuff together, or dollar value LIFO. And dollar value LIFO is what most companies use. So imagine this is your job, to work at the grocery store and come up with dollar value LIFO. Ugh. It's a nightmare for me. So, the primary advantage is the tax benefit, which the tax benefit is no small advantage because it helps your cash flow, right? Think about me, myself. I'm trying to minimize my taxes, my personal taxes, right? Because it affects my bank account and my cash flow, right? And companies do the same thing. They try to figure out, what thing makes the most sense tax-wise. A lot of taxes just guide a lot of business stuff. Oh, and the poor buying habits on the last one up here. If you accidentally, eat into your inventory, then that can cause big problems under dollar value LIFO. So a lot of times it's just kind of an unspoken rule. Let's keep our inventory at least at this level so it won't mess us up. All right. Switching from FIFO to LIFO, you get a tax benefit. If a company switches from FIFO to LIFO, you get a tax benefit. But I think a lot of people have already played that game. So, all right. So I think we're done with this part. So let's just work problems now.